global now, we start from the United States. The Trump administration has said that it's imposing tariffs on 60 of the country's top trading partners, covering nearly all of U.S. imports, for failing to tackle the making of goods by forced labor. I believe Nigeria has also been named in this. The U.S. Trade Representative said that it had initiated investigations in March into the 60 economies at the directive of President Donald Trump related to their failure to impose and effectively enforce a prohibition on the importation of goods produced with forced labor. According to a separate fact sheet published by the agency, U.S. trading partners that have made commitment to enforce forced labor import prohibitions will be hit with 10% tariffs, while those who have not adopted such prohibitions will have a 12.5% tariff rate, and countries that will be hit with a 10% rate include Canada, Mexico, the UK, and India. Trust President Trump, he always knows how to start one trouble or the other. Well, Iran has rejected a U.S.-backed ceasefire proposal delivered by Iraqi Prime Minister Ali al-Zaida, dismissing a temporary truce as President Donald Trump stepped up threats to target the country's critical infrastructure. This is according to the New York Times, citing Iranian and Iraqi officials. The latest diplomatic setback comes as the conflict between Washington and Tehran has intensified sharply in recent weeks. On Thursday, President Donald Trump vowed major military punishment against Iran and its Houthi allies after the Yemeni group attacked 2 Saudi oil tankers in the Red Sea, opening a second major shipping front alongside the Straits of Hormuz. The escalating threats have fueled fears of broader disruptions to global energy supplies, sending Brent above $100. We saw it taper a bit this morning for the first time since May, after it surged 6%. Tehran said that it was unwilling to accept a temporary deal that has left unresolved the issue of control over the Strait of Hormuz, which is one of the world's most important oil shipping choke points. And the proposal was said to be the only ceasefire offer currently under consideration. From the US, the UK retail sales there increased 1% in June. This according to data released by the Office of the National Statistics. The rise follows a 1.2% increase in May 2026 and exceeding what economists had expected, which was a 0.3% decline. The Statistics Office said that retailers attributed the June growth to sales promotions and warm weather, which boosted demand for outdoor products, fans, air conditioning units, and sports merchandise. The NET office reported that June 2026 was the second warmest June on record for the second quarter of 2026. Retail sales volumes rose 0.6% compared with the first quarter. The quarterly increase represents a 2.8% rise compared with the 3 months ending in June 2025. Non-store retailers, which include online sellers and market stores, showed strong performance in May and June. Sales volumes in this category increased as consumers purchased outdoor products, which include fans, clothing, and sports merchandise. Clothing stores recorded a 1.9% monthly rise in June, marking their largest monthly increase in September 2025. None of this has been affirmed by the Statistics Office, and they say that retailers are reporting that sales promotions and warm weather drove growth. Non-food stores, they also posted 1.2% increase in the second quarter. And Volkswagen Group has cut its 2026 sales revenue forecast to a range of 3% decline to flat compared with previous year, and that's down from its prior forecast of 3% growth. The German car maker cited the macroeconomic environment, uncertainty around international trade restrictions, and geopolitical tensions, intensifying competition, volatile commodity, energy, and foreign exchange markets, and changing emissions-related regulatory requirements as key challenges to its outlook. The company kept its operating return on sales guidance unchanged at 4% to 5.5%, and Volkswagen's operating result fell 11.6% to 5.93 billion euro in the first half of 2026, and that's down from 6.7 billion euro a year earlier. And near France, the private sector contraction eased in July, with services output slowing only marginally. Although inflation, borrowing costs, and geopolitics, they all remain concerns as tensions in the Middle East flare up again. This according to a business survey that was shared earlier today. The S&P Global Flash France Composite Output Index went up 49.6% from 47.2% in June. That's a preliminary survey. Of course, we know that 50 marks growth from contraction. A poll earlier for the July Flash Composite stood at 47.8%. We move to Asia now. Japanese consumer price index inflation grew as expected in June, while core inflation advanced but still remains below the Bank of Japan's annual target. Core CPI inflation, which includes volatile fresh food prices, that rose 1.6% year on year, according to government data. The print is in line with expectations and remains below the BOJ's 2% annual target. A core reading that excludes both fresh food and energy prices that fell 1.7% in June from 1.8% in the prior month. The print is closely watched by BOJ as a gauge for underlying inflation. Headline CPI went up 1.7% year on year from 1.5% in the prior month, and that's the highest CPI reading for the year. Inflation picked up but remains relatively subdued, as government subsidies on fuel and utility largely is shielding the public from high commodity prices stemming from the Middle East war. Still in Asia, once the world's third largest cocoa producer, Indonesia is seeking to revive cocoa production after years of underinvestment, aging trees, pests. That's left the industry short of beans and increasingly dependent on imports. The country's 11 cocoa processors can now grind more than 750,000 tons of beans a year, but they're operating at only 60% of capacity because local harvests have steadily declined. And this is according to the industry ministry. Reviving domestic supply is a key focus for Indonesia's Cocoa Conference and dinner, which is holding this week. And in India, SBI Funds Management, their shares fell briefly below their offer price just 4 days. That's the largest IPO in India after their trading debut, signaling weak secondary market demand for the nation's largest asset manager. The stock declined as much as 0.9% to 570 rupees today, Friday, versus an initial public offering price of 574 rupees before reversing the losses to trade at 578.60 rupees. And the US-Israeli war on Iran has sparked a Diet Coke shortage in India by squeezing supplies of aluminum cans, triggering an unusual wave of Diet Coke parties in one of the world's largest consumer markets. But now the fizzy drink is getting pricier. Across India, Coca-Cola has hiked prices of Diet Coke, which is sold predominantly in aluminum cans in the country, by more than 10%, and that's because of the ongoing Middle East conflict. This has choked its supply chain. As a result, the company has been forced to procure pricier, larger sized cans from Southeast Asia, and the impact is still being counted at this time, but who would have thought that Diet Coke will be affected by the war? Those are the global stories for this time.